What is the buy and hold strategy? The buy and hold strategy is a long-term investment approach where investors purchase securities and maintain ownership regardless of market fluctuations. Unlike active trading, this passive strategy requires patience and a long-term perspective. This strategy is based on the belief that markets generally increase in value over extended periods, despite short-term fluctuations. As you can see, while markets may fluctuate in the short term, the overall trend tends to be positive over longer periods. Investors using the buy and hold strategy select quality investments with growth potential and commit to holding them for years or even decades. They ignore short-term market fluctuations and allow compound interest and time to work in their favor. The buy and hold strategy exemplifies the patient approach to wealth building through long-term market participation. Buy and hold investing offers several key advantages for investors. Let's explore the 6 major benefits that make this strategy so powerful. First, let's look at reduced transaction costs. Buy and hold investors trade far less frequently than active traders. With fewer trades, buy and hold investors save significantly on commission fees, bid-ask spreads, and slippage costs. The second major benefit is tax efficiency. When you hold investments for more than 1 year, you qualify for long-term capital gains rates. These rates are substantially lower than short-term capital gains, which are taxed as ordinary income, potentially as high as 37%. The third benefit is the minimal time commitment required. Active traders often spend 20 or more hours per week researching and executing trades. In contrast, buy and hold investors typically need just 1 to 2 hours per week for basic portfolio monitoring and occasional research. The fourth benefit is reduced emotional decision-making. Market volatility often triggers fear and greed responses. Buy and hold investors are less affected by these emotions, as their strategy focuses on the long-term trend rather than short-term fluctuations. The fifth benefit is the power of compound growth. When investments are held for decades, even modest returns can generate impressive results. With an 8% annual return, $1 grows to $2.16 after 10 years. After 20 years, it becomes $4.66. And after 30 years, it grows to more than $10, a tenfold increase of the initial investment. The sixth benefit is avoiding the pitfalls of market timing, a notoriously difficult task that even professional investors struggle with. Research shows that missing just the 10 best market days over a 20-year period can cut your returns nearly in half. Miss the 20 best days, and returns drop by more than 2/3. Miss 30 days, and your returns are nearly zero. To summarize, buy and hold investing offers 6 major benefits that can significantly improve your investment results. Successful buy and hold investing requires selecting quality investments that can compound value over time. There are 4 essential criteria to consider when selecting investments for a buy and hold portfolio. First, look for companies with strong competitive advantages that can maintain their market position for decades. Second, seek businesses with consistent revenue growth, as this drives long-term compounding. Third, favor companies with solid balance sheets and low debt levels to weather economic downturns. Finally, prioritize sustainable business models that won't become obsolete as technology and consumer preferences evolve. Buy and hold investors typically focus on 4 main categories of investments. Blue chip stocks are shares of large, well-established companies with reliable performance histories and often pay consistent dividends. Broad market index funds provide instant diversification across hundreds of companies, reducing single stock risk while capturing overall market growth. Dividend aristocrats are companies that have increased their dividend payments for at least 25 consecutive years, demonstrating remarkable business stability. Companies with wide economic moats possess structural advantages that protect them from competition, enabling them to maintain high returns on capital for decades. Economic moats are competitive advantages that protect a company from competitors, just as a castle moat provides protection from invaders. These protective factors include brand power, economies of scale, high switching costs, network effects, and patents or proprietary technology. The careful selection of quality investments leads to significant outperformance over decades. While the market average delivers solid returns, carefully selected quality companies with competitive advantages can significantly outperform over 20-year holding periods. Meanwhile, poor investment selections tend to significantly underperform, highlighting the importance of careful company research and selection. Common misconceptions about the buy and hold strategy can lead investors astray. Misconception number one: many investors mistakenly think that buy and hold means buy and forget. The reality is that proper implementation requires periodic portfolio reviews. Successful buy and hold investors typically review their portfolios quarterly to ensure their investments remain aligned with their goals. Misconception number two: buy and hold does not mean never selling. The reality is that strategic selling is sometimes necessary. Successful buy and hold investors recognize when selling is appropriate. There are three primary valid reasons to sell: when company fundamentals deteriorate significantly, when your personal financial goals change, or when better opportunities arise. Misconception number three: buy and hold does not mean ignoring market realities. The reality is that buy and hold investors understand market dynamics, but choose not to react to short-term volatility. Successful buy and hold investors recognize the difference between normal market fluctuations and fundamental shifts in market conditions. In essence, buy and hold means staying focused on your long-term investment goals despite the inevitable short-term market noise. Let's compare buy and hold investing with active trading strategies. Buy and hold investing and active trading represent two fundamentally different approaches to the market. With buy and hold, investors purchase quality assets and hold them for the long term, largely ignoring short-term market fluctuations. Active trading, by contrast, involves frequent buying and selling in an attempt to profit from short-term price movements. One of the key advantages of buy and hold is significantly lower transaction costs. Active traders can pay up to 6 times more in commission fees and trading costs compared to buy and hold investors. For a portfolio of $100,000, an active trader might spend $30,000 on transaction costs over a decade, while a buy and hold investor might spend only $5,000. Tax consequences also favor buy and hold investors. Long-term capital gains are taxed at lower rates than short-term gains. On a $10,000 profit, active traders might pay up to $3,700 in taxes, while buy and hold investors would pay a maximum of $2,000. When we examine long-term performance, the data is clear. While active trading may generate higher returns in certain market conditions, sustaining this outperformance over decades is extremely rare. Historical data shows that buy and hold strategies tend to outperform active trading over long time horizons. Active trading's theoretical advantages are often eroded by transaction costs, taxes, and the inherent difficulty of consistently timing market movements. Research consistently shows that around 90% of active fund managers underperform their benchmarks over a 15-year period. Successful market timing requires being right twice: when to sell and when to buy back in. Studies have shown that missing just the 10 best days in the market can reduce your returns by up to 50%. There are 4 main reasons why active trading typically underperforms buy and hold over time. Transaction costs accumulate significantly. Taxes take a larger bite from active trading profits. Psychological biases often lead to poor timing decisions. And accurately timing market movements is extraordinarily difficult, even for professionals. While active trading can work for certain investors with specific expertise and resources, the evidence strongly favors buy and hold for most long-term investors. The greatest challenges of buy and hold investing are not technical, but psychological. Investors using buy and hold strategies must navigate significant emotional hurdles, particularly during market volatility. Let's look at a typical market journey over a 10-year period. Notice the significant ups and downs that test an investor's resolve. During market downturns, investors face the powerful urge to panic sell. This often occurs at the worst possible time, locking in losses near market bottoms. Conversely, during bull markets, investors are tempted to chase performance, often buying high after missing earlier gains. Yet the disciplined investor recognizes that despite short-term volatility, the long-term trend typically rewards patience. Let's examine the key psychological challenges that buy and hold investors must overcome. Loss aversion bias is particularly powerful. Studies show that the pain of losing money feels about twice as strong as the pleasure of gaining the same amount. Successful buy and hold investors develop specific strategies to overcome these psychological challenges. Let's compare how emotional and disciplined investors behave differently during various market conditions. Maintaining perspective during volatile periods by focusing on long-term objectives rather than short-term fluctuations is the key psychological skill for buy and hold success. Dollar cost averaging is a powerful complement to the buy and hold strategy. Dollar cost averaging, or DCA, means systematically investing fixed amounts at regular intervals regardless of market conditions. Let's see how DCA works with a monthly investment of $500 over 6 months. Note how the share price fluctuates each month, but we consistently invest the same amount regardless of market conditions. Here's how the market price fluctuated over our 6-month investment period. Notice the significant price movements both up and down. With dollar cost averaging, these fluctuations actually work to your advantage. With our fixed dollar amount, we automatically buy more shares when prices are low and fewer shares when prices are high. Over time, you accumulate a total of 61.4 shares at an average cost of 48.07 cents per share. Dollar cost averaging offers several key benefits that complement the buy and hold strategy. It reduces the impact of market volatility and eliminates the pressure of trying to time market entry points. The process becomes automated, requiring less active decision-making while potentially lowering your average cost basis over time. This approach perfectly complements a long-term buy and hold strategy, reinforcing disciplined investing habits. Let's look at some practical tips for implementing dollar cost averaging. First, set up automatic investments on a regular schedule to remove emotion from the process. Importantly, continue investing during market downturns. This is when DCA provides its greatest advantage. This approach works well for retirement accounts and other long-term financial goals. Consider combining DCA with broad market index funds for additional diversification. Finally, stay consistent with your investment amount to fully realize the benefits of dollar cost averaging. Even within a buy and hold strategy, periodic rebalancing is essential to maintain your desired asset allocation. Let's start with an example portfolio that has a target allocation of 60% stocks, 30% bonds, and 10% cash. As different investments perform differently over time, your portfolio weightings will naturally drift. In our example, after a period of strong stock market performance, stocks have grown to 75% of your portfolio, while bonds and cash have decreased to 20% and 5% respectively. Rebalancing is the process of adjusting your portfolio back to its target allocation. Let's explore what this means. This chart shows how different assets grow at different rates over time. Stocks typically grow faster than bonds and cash, causing your allocation to drift. Rebalancing offers several important benefits that support your long-term investment goals. There are two main approaches to rebalancing: time-based and threshold-based. Time-based rebalancing occurs at regular intervals, like annually or semi-annually, while threshold-based rebalancing happens when your allocation drifts beyond a predetermined percentage. Remember, Rebalancing is not contradictory to buy and hold investing. It's a disciplined approach that manages risk while still adhering to long-term investment principles. Is the buy and hold strategy right for everyone? While buy and hold has proven effective for building long-term wealth, it's not universally ideal for all investors or financial situations. Time horizon is a critical factor in determining whether the buy and hold strategy is appropriate. Those with shorter time horizons, typically less than 5 years, may need more conservative approaches. Similarly, individuals requiring regular income from investments might need to modify the strategy. Buy and hold typically favors growth over current income, making it less ideal for retirees who need consistent withdrawals from their portfolio. Buy and hold requires substantial emotional discipline. Investors must withstand market volatility without panic selling during downturns. Not all investors have the temperament to stay the course when markets become turbulent. Buy and hold works best for investors with long time horizons, stable income sources, emotional discipline, and clear financial goals that align with the patience required for this approach. If your situation differs, you may need to modify the strategy or explore alternatives that better match your needs. Remember to carefully evaluate your personal financial situation and goals before committing to any investment strategy.